You want to buy a home, but the median home price is $439,000. Mortgage rates are at 6.3%. You need $123,000 household income just to afford the average home. The median age of first-time buyers has jumped to 38 years old, up from 29 just a decade ago. And only 24% of all home purchases are first-time buyers, the lowest number ever recorded. It feels impossible, and honestly, for a lot of people, it is harder than it's ever been. But here's what most people don't know. Right now, in 2026, there are 2,624 first-time buyer assistance programs available nationwide, offering an average of $18,000 in benefits, grants up to $30,000 that don't need to be repaid, down payments as low as 0%, and strategies most buyers have never heard of. Today, I'm giving you the complete, honest roadmap to buying your first home, even when everything feels too expensive. Step 1. Know your real numbers. And I mean all of them, not just the mortgage payment. Most first-time buyers make one critical mistake. They calculate what they can afford based on the home price, not the total cost of ownership. Here's the complete monthly cost picture. On a $350,000 home with 5% down at 6.3%, mortgage, principal, and interest, $2,072 per month, property taxes, approximately $323 per month, homeowner's insurance, $150 per month, PMI, since you're putting less than 20% down, $175 per month, maintenance reserve, $292 per month, total, $3,012 per month. That's $912 more per month than just the mortgage payment alone, and closing costs add another $7,000 to $17,500 up front on top of your down payment. The single most common mistake first-time buyers make is starting their search with a price range based on rough guesswork instead of real numbers. The 28% rule. Your total housing costs should never exceed 28% of your gross monthly income. At $3,012 per month, you need a gross income of at least $10,757 per month, or $129,000 per year to stay in the safe zone. Step 2. Build your credit score aggressively because it's worth tens of thousands of dollars. Here's the exact math. Step 2. Build your credit score aggressively because it's worth tens of thousands of dollars. Here's the exact math. On a $350,000 mortgage, the difference between a 620 credit score and a 760 credit score is approximately 1.5 percentage points in interest rate. At 620, you might get 7.1%. At 760, you might get 5.6%. That 1.5% difference costs you $356 more per month. Over 30 years, that's $128,160 in extra interest, just from having a lower credit score. So how do you build your credit fast? 3 specific moves. Move 1. Pay down your credit card balances below 30% utilization. This is the single fastest way to improve your score. Move 2. Don't close old accounts. Length of credit history matters. Move 3. Dispute any errors on your credit report. 1 in 5 Americans has a credit report error that is lowering their score. Check yours at annualcreditreport.com. It's free. Getting your score from 620 to 760 before buying could save you $128,000. That is worth more than any down payment assistance program. Step 3. Find the free money most first-time buyers completely miss, and I mean literally free money. There are a record 2,624 assistance programs nationwide as of Q3 2025, offering an average of $18,000 in benefits. Here's what's available right now in 2026. The federal home loan banks have allocated over $30 million for 2026 home buyer grants of up to $30,000 per household. That's a grant you never pay back. FHA loans require only 3.5% down with a 580 credit score. That means on a $350,000 home, you only need $12,250 down instead of $70,000. VA loans, if you've served in the military, require zero down payment and no private mortgage insurance, saving you $175 per month minimum. USDA loans, available in rural and suburban areas, covering 97% of U.S. land, also require zero down payment. State housing finance agencies in all 50 states offer below-market interest rate mortgages and down payment assistance. California's Dream for All program offers up to 20% down payment assistance, and Assumable mortgages, available on all FHA and VA loans, let you inherit the seller's lower interest rate from when they bought. If a seller bought in 2021 at 3%, you can take over that mortgage and save thousands per month. Step 4. Location arbitrage. And this single strategy has unlocked home ownership for more people than any other in 2026. Here's the concept. The same $350,000 budget buys you a completely different home depending on where you look. In San Francisco, $350,000 doesn't exist as a home purchase. In Los Angeles, it might get you a small condo. In Austin, Texas, it gets you a decent 3-bedroom home. In Memphis, Tennessee, it gets you a beautiful 4-bedroom home in a good neighborhood. In parts of Ohio, Indiana, and Michigan, $350,000 gets you a genuinely stunning home. Here's what's even more powerful in 2026. Remote work has permanently changed the equation. If your job is remote, you can earn a high-cost city salary while paying low-cost city prices. A software engineer earning $130,000 remotely from San Francisco, moving to Memphis, Tennessee, instantly sees their housing affordability triple. The top affordable markets for first-time buyers in 2026 include Pittsburgh, PA, Memphis, TN, Indianapolis, IN, Columbus, OH, San Antonio, TX, and Oklahoma City, OK. In all of these cities, median home prices are under $250,000, and qualifying income requirements are dramatically lower. Step 5. Get pre-approved. Before you look at a single home, not pre-qualified, pre-approved. Here's the difference. Pre-qualification is a rough estimate based on what you tell the lender. Pre-approval is a real underwriting process. They verify your income, assets, and credit. And in 2026's competitive market, pre-approval is the difference between getting a home and losing it to another buyer. When you make an offer with a pre-approval letter, sellers know you are serious. You can close. And here's something most buyers don't know. Get pre-approved by at least 3 different lenders. Studies show that getting just one additional quote saves the average borrower $1,500 over the life of the loan. Getting 5 quotes saves an average of $3,000. Lenders compete for your business. Use that competition. And ask every lender about every program you might qualify for. First-time buyer programs, state assistance, FHA, USDA, VA. Most lenders won't volunteer this information. You have to ask specifically. Step 6. Buy smart, not perfect. And this mindset shift has helped more first-time buyers get into homes than any financial strategy. Here's the truth. Your first home does not need to be your forever home. It just needs to be your first home. The strategy is called the Starter Home Ladder. Buy a modest home in a good location that you can afford comfortably today. Build equity over 5 to 7 years. Use that equity as the down payment for your next, better home. Specifically look for cosmetically challenged homes in structurally sound condition. A home that needs new paint, new flooring, new fixtures, but has a good roof, good foundation, good plumbing, can be bought at a 10 to 20% discount to market, and your sweat equity, doing the cosmetic work yourself, instantly builds value. Also look at new construction incentives. Builders in 2026 are offering rate buydowns, paying to lower your interest rate temporarily or permanently. Some are offering 2-1 buydowns, where your rate is 2% lower in year 1, 1% lower in year 2, then settles at the market rate in year 3. This can dramatically reduce your initial monthly payments while you grow into the home financially. Step 7. Time your purchase strategically. Most buyers don't realize that the season and timing of their purchase has a real financial impact. The most expensive time to buy a home is May through August. Spring and summer bring more buyers, more competition, more bidding wars, and higher prices. Studies show homes purchased in December and January are bought at an average 3 to 4% discount to peak season prices. On a $350,000 home, that's $10,500 to $14,000 in savings, just from timing. Also watch the specific market conditions in 2026. States like Florida and Texas, where there's too much supply, have actually seen prices decline in 2025. And some of the metro areas that had explosive price growth after COVID, Boise, Las Vegas, and Phoenix, are also seeing prices fall. If you're targeting one of these markets, you may have more negotiating power than you think. Make aggressive but reasonable offers. Ask for seller concessions. Having the seller pay 2 to 3% of closing costs is becoming more common again in buyer-friendly markets. Step 8. The complete savings plan to get you to closing. Here's the exact roadmap. Target a $350,000 home with 5% down using an FHA or conventional loan. Down payment needed, $17,500. Closing costs, approximately $7,000 to $10,500. Emergency fund after closing, $5,000 minimum. Total cash needed, $29,500 to $33,000. Now apply for assistance programs. Federal Home Loan Bank grant, up to $30,000. State down payment assistance, average $10,000 to $18,000. That assistance alone could cover your entire down payment and closing costs, leaving you just needing the emergency fund. For the savings plan itself, open a high-yield savings account earning 4.5%. Set an automatic transfer of whatever you can, even $500 per month. If you save $1,000 per month, you reach $30,000 in 30 months, 2.5 years, while simultaneously working on your credit score, while simultaneously researching assistance programs, while simultaneously getting pre-approved, all running in parallel. This is the complete system. Here's the bottom line. Buying your first home in 2026 is harder than it was for your parents. Full stop. The median home price is higher. Rates are higher. Down payments are larger. But it is not impossible. There are 2,624 assistance programs offering free money. There are loan options requiring 0% to 3.5% down. There are market timing strategies that save thousands. There are location arbitrage opportunities that transform affordability. And there is a clear 8-step system that, if you follow it, will get you from renter to homeowner. It just takes longer than before and requires more strategy than before. Subscribe, because next week we're doing a deep dive on assumable mortgages, the strategy that lets you inherit a seller's 3% interest rate in a 6.3% world and could save you $600 per month. You don't want to miss that one.